This is Nightly Business Report with Tyler Matheson and Susie Garrett. Funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
Burger Blues McDonald's posts its biggest domestic same-store sales drop in more than a decade, and investors hit the eject button. If McDonald's is getting it wrong, which company is getting it right?
Losing energy, crude prices fall to a fresh 5-year low, and now some big oil companies may be forced to rethink their spending plans for 2015.
And cashing in, put your money in the stock market or use it to buy a home, what some experts say is the better way to build wealth. All that and more tonight on Nightly Business Report for Monday, December 8th.
Good evening, everyone. A 1-2-3 punch today from energy, technology, and yes, burgers. Stocks fell sharply as oil prices sank, tech tumbled, and a Dow component issued a profit warning. And we begin tonight with that Dow component, McDonald's. The world's largest restaurant chain reported a steeper than expected drop in global sales across all regions, including a sharp decline in the U.S. That's the 6th straight month of falling worldwide sales, and that, along with a strong dollar and supply issues in China, the company warned will hurt its fourth quarter earnings. The stock got fried, losing almost 4%, making it one of the worst performing stocks on the Dow Jones Industrial Average. So what's behind McDonald's slump, and what does the company have to do to get back on track? Sarah Eisen reports.
November brought with it supersized disappointment for McDonald's. The fast food giant reporting same-store sales falling much more than expected for the month, dropping more than 2% globally. Europe and Asia, once key growth regions for the Golden Arches, are now showing signs of weakness, thanks in part to slowing economies and a supplier scandal in China. The outlook at home, even more bleak. Increased pressure from the likes of Chipotle and Wendy's, as well as changing consumer preferences, taking its toll on McDonald's. Sales in the U.S. falling nearly 5%, more than twice the decline analysts predicted.
The issue here is McDonald's more than the industry. And right now, this is a company that needs to probably reinvest in food value or do something to stimulate traffic.
But that task may be easier said than done. And figuring it out falls on McDonald's CEO Don Thompson, who's faced a challenging environment ever since taking over the company in 2012. Growth was a mainstay under the previous CEO, with the company delivering an annual rate of 5%. But the last few years have not been nearly as kind to the company. In 2013, McDonald's share of U.S. fast food hamburger chains revenue slipped below 50%. And this year, analysts predict the company will post its first year of negative global same-store sales since back in 2002.
The challenge for them is really not only turning around the U.S., but you got to turn around Japan, you got to turn around Germany, you got to get France going, and Russia as well. So it's not just a domestic story. You got to fix a lot of different markets.
What do we want? 15!
The company also facing labor pressures, being thrust into the spotlight by campaigns to improve wages and working conditions for the nation's fast food workers. All of that taking a toll on McDonald's stock over the last 6 months, underperforming the S&P 500 by about 15%. And with consumers in the U.S. and abroad moving further away from the Golden Arches, it remains to be seen just how much longer investors can stomach the slumping fast food giant's performance. For Nightly Business Report, I'm Sarah Eisen.
So what's McDonald's next move, and what are some of the best ways to make money off of global appetites? Ephraim Levy is senior equity analyst at S&P Capital IQ. Mr. Levy, welcome. Good to have you with us. You've got a hold on McDonald's. What do they need to do to jumpstart business? And is Don Thompson the right guy to do it, or does he have to go?
Well, it's going to be a challenge to turn around the business. Has been indicated earlier in the story. It's a global issue. If you look at China, that's something that should hopefully resolve itself. There's supplier issues later in 2015. In Europe, you have issues of a weakening economy there, plus politics is hurting the Russian sales. That could correct itself, too, if we see growth there. The real challenge is the U.S., where we're seeing weakness in the sector, where people are going more to the quick service, the fast casual restaurants and taking away share from McDonald's. And they have.
So what do they need to
do?
What do they need to do?
So that's what I'm about to get to. Is that it's not a whole lot they can do. They're trying an experiment to customize. The people can choose what type of burger they want versus the quick service order that you usually got. But there's a lot of the customers, they just want the quickness and the burger. As far as trying new products, they've done healthy products, and that really hasn't stuck. They've got to try things and find something that works, and it's not easy.
It's obviously not easy, Ephraim. Don Thompson is supposed to be having an investment conference this Wednesday. What do you and other investors need to hear from him now that'll make you feel better that they have a plan in place?
Well, really, that's it, that they have a plan that sounds like it's executable. As I said, it's not going to be easy turnaround. First, they got to stabilize it, and then they got to find out how to grow it. But they are, the good news is they have a lot of cash flow that supports the initiatives.
You've got a buy on Starbucks, Ephraim. Why, and what are they doing right that McDonald's is missing?
Well, they're in a different category in terms of their brand placement. They're more upscale. It's not someone who's paying 50 cents for coffee. It's someone who's going to pay $4 or $5 for their coffee. And they're able to, firstly, grow their global business. They're still in a smaller stage than McDonald's is. But they're also innovating by adding to their core coffee. They're adding not fresh food, but they're adding food that's available. So you could add to your ticket. You can get a snack. And they're also even changing looking for new formats for their store to grow. And finally, they're staying ahead by technology. Pretty soon you're going to be able to have a coffee delivered to your office. You can't do that at McDonald's.
Well, we know a lot of the young millennials, the 20-somethings, they're looking for quality, healthy food, and no matter how much McDonald's seems to be adding healthy offerings on its menu, people still think of the McDonald's brand as hamburgers and French fries. So is this just a problem that they have with their brand name?
That's it exactly. That people are looking, they have a core people who are going to buy that, who want something cheap, something fast. But if you want something more upscale, like a Chipotle, they have a different atmosphere there. They're able to charge higher prices. It's healthier, or at least perceived to be. And that's helping Chipotle be able to not only raise prices, but have more customers at the same time. If McDonald's raises their prices, they'll probably lose customers.
I read an article last week that indicated that some critics think that McDonald's have too many menu choices. Do you agree with that?
I think that's part of it, an issue, because they're trying to catch up and give more choices so they can get every consumer. But they lose their quick service reputation. If it takes a delay for your order, people won't come back who would otherwise would.
All right, Mr. Levy, thank you very much for being with us. We appreciate it.
My pleasure.
Ephraim Levy is Senior Equity Analyst at S&P Capital IQ.
Well, McDonald's wasn't the only stock pressuring the blue chip average today. Chevron and ExxonMobil were also a drag as oil prices fell to fresh 5-year lows. One reason for the decline in prices, weak data out of two of Asia's biggest economies. China's exports grew at a slower than expected pace, and imports dropped while Japan's economy shrank more than expected last quarter. Another reason, Morgan Stanley cut its forecast for Brent crude next year, citing oversupply. By the close, the Dow fell 106 points. The Nasdaq slid 40 as investors sold large-cap technology shares, and the S&P 500 down 15. Over in the oil markets, prices fell more than 4% to settle at its lowest level since July 2009.
And because of those falling crude prices, ConocoPhillips plans to spend less next year. The oil and gas producer says its capital budget for 2015 will drop 20% and that it will defer significant investment in 2 fields in Canada, in the Permian Basin in Texas, and other less developed shale oil sites in North America.
And ConocoPhillips is just one of many oil companies scaling back. Jackie DeAngelis reports on how lower oil prices are changing energy companies' spending plans.
Low crude prices are causing oil and gas companies to rethink their operations in 2015. Just this weekend, BP announced it would speed up job cuts in the U.S. and overseas because of recent price drops. And others like Statoil extending the suspension of 3 drilling rigs to manage costs in the face of shrinking margins. And it doesn't end there. Research firm Rystad Energy is expecting to see oil and gas exploration projects in 2015 take a hit as well. As a matter of fact, the firm says that we could see 1/3 of projects being cut, accounting for $150 billion of investment. Where can we expect to see cuts? in the highest areas of cost operations, including Arctic Russia, Canada, and Alaska, but also in other complicated deep water projects. Shale oil could be impacted, but sees more flexibility if crude stays over $60. In addition, many are looking at the credit markets where money was raised for these projects, wondering if there will be increased bankruptcy risk for smaller shale drillers. The Rystad analyst I spoke to said he thinks that most of these companies will survive by cutting spending on drilling to balance cash flows, and that some of them are comfortably hedged for 2015. Meantime, Deutsche Bank says while energy-related capital spending should slow if oil prices remain depressed for a significant period of time, it may only impact inflation-adjusted output by a tenth or two, which isn't too significant. The main takeaway there, that less capex spending by energy companies is less significant than the boost the economy will receive as a result of cheaper oil. For Nightly Business Report, I'm Jackie DeAngelis.
As oil prices fall, the push to lift the 40-year-old ban on oil exports grows. Texas Republican Congressman Joe Barton plans to introduce such a bill tomorrow. But the measure is given almost no chance to pass as lawmakers worry about rising fuel prices and costs to refiners. The export ban, you'll remember, was passed in the 1970s after the Arab oil embargo created fuel shortages. And cheaper oil, of course, means cheaper gasoline. And the latest Lundberg survey shows the average price of a gallon of gas has dropped a whole $1 since early May. That is the lowest price in more than 4 years. In the past 2 weeks, regular gasoline prices have fallen another 12 cents, says Lundberg. And AAA found that the average price for a gallon of regular today, $2.67, and it should keep falling now to 5-year lows pretty soon. And now to some merger news. A drug company and Dow component Merck announcing a major acquisition today of drug maker Cubist Pharmaceuticals. In a down market, the news sent Merck shares up fractionally and Cubist stock soaring 35%. Meg Terrell explains why the deal is putting renewed attention on an often ignored part of the drug market.
Drug giant Merck is making a big move in an area abandoned by many large drug makers. The company's paying almost $10 billion to acquire Cubist Pharmaceuticals, a maker of antibiotics. It's been a tough area for drug development in recent years, as regulatory hurdles and a low return on investment have driven many companies away.
Virtually all big pharma companies essentially eliminated their discovery capabilities, most of their development capabilities, and very few of them even market antibiotics.
And as bacteria become resistant to existing drugs, becoming what are known as superbugs, policymakers and companies are responding to a growing public health threat.
Every year in this country, about 2 million people have a form of infection that's resistant to conventional antibiotics. About 23,000 of those people die.
With Cubist, Merck gets the billion-a-year antibiotic Cubicin, as well as a slate of other drugs administered in the hospital setting. Cubist is expected to receive approval of another experimental antibiotic this month, which analysts estimate could draw more than $1.5 billion annually. Merck's move in the space should signal optimism for companies focused on antibiotics, said Robert W. Baird analyst Brian Scorney.
So I do think antibiotics are a good place to be invested in right now.
The question is, as the threat of superbugs looms, do other large drug makers agree? In San Francisco, for Nightly Business Report, I'm Meg Terrell.
Still ahead, the sector that could benefit when consumers have a little more money in their pockets. The U.S. is suing Deutsche Bank on an alleged scheme to avoid federal income taxes. The government hopes to recover more than $190 million in taxes, penalties, and interest. Also named as a defendant, Wells Fargo, which acted as a trustee for Deutsche Bank in the matter. In a statement, Deutsche says it is fully addressing the government's concerns.
A top Federal Reserve official said today he expects the central bank to stay on track to begin raising interest rates in the latter half of next year. Atlanta Fed President Dennis Lockhart says the weak global economy and low inflation remain a risk to the U.S. economy, and he's worried that inflation hasn't picked up yet despite labor market improvement. But he still expects the economy to grow at around 3% in 2015. Now, Lockhart isn't a current voting member on the Fed's main policy committee, but he will have a vote next year.
In their latest quarterly survey, the wild and crazy members of the National Association for Business Economists say they doubt the Fed will raise interest rates above 1% by the end of 2015, as central bank officials currently project. NABE expects the gross domestic product to expand by just under 3% next year, very close to the Fed's own expectation, and members are now more upbeat about overall U.S. growth in this survey than they were this past summer.
Maybe it's lower gas prices, maybe a new job, but Americans seem to be buying things they want again rather than just necessities. And that's done wonders for a much maligned sector of the stock market, as Morgan Brennan reports.
It looks like consumers have a little more money in their pockets, and they're spending it on things they don't necessarily need. So after lagging the S&P 500 all year, consumer discretionary stocks have rallied, one of the best performing sectors over the past month. The holidays have helped fuel the gains, with Target one of the biggest winners. But home builder, media, and leisure companies have also done well. Experts say the big boost can be chalked up to several economic factors.
When you look at the lower energy prices, we've really seen a tremendous pullback in both oil prices and gasoline prices that'll affect consumers' confidence and extra spending power over the next several months. That's starting to feed into those equities that are behind those consumer companies.
Rising employment also helps. Hogan expects restaurant stocks like Buffalo Wild Wings to benefit from all of those factors first, since folks tend to eat out more regularly when there's more money to spend. But what about retailers? Aggressive holiday strategies are expected to increase sales this season, but at risk of profits. Best Buy and Urban Outfitters, two brick-and-mortar apparel companies, are expected to see double-digit online growth. Yet both have fallen so far this month, and experts say that could continue. But others will stand out.
We're big fans of Deckers that make Uggs. We like Worldwide Wolverine. They have a whole host of shoes that they make, and handbags. We like Kate Spade and Vera Bradley. They're really reinventing themselves. So as Michael Kors and Coach are sort of losing market share, Kate Spade and Vera Bradley are picking up market share.
Auto parts companies and auto retailers are also enjoying a lift on surging car sales. Goodyear Tire and Rubber, Delphi Automotive, and O'Reilly Automotive have all rallied by double digits since the start of the quarter. And many analysts expect those names to drive further gains next year. For Nightly Business Report, I'm Morgan Brennan.
Wells Fargo is now the most valuable U.S. bank ever, and that is where we begin tonight's market focus. The firm surpassed Citigroup's 2001 record market value, finishing Friday's trading session with a market cap of more than $285 billion. The company, which counts Warren Buffett as its largest shareholder, has doubled in size since 2008 with its purchase of Wachovia. Shares were off a fraction. Nonetheless, today they closed at $54.77. Vail Resorts says sales of new ski passes grew, helping the resort operator narrow its quarterly loss. The company also announced a $50 million investment plan. Part of that investment will fund a connection between two of its Utah locations to create what it says will now be the biggest single ski area in the U.S. Despite that, Vail was down sharply today, 2.5% at 89.12. Sony was hit by another cyber attack today. The company's PlayStation online store hacked, leading to a 2-hour outage. Sony says it is investigating the cause. Just last month, the company's Hollywood studio was hit by a massive attack that shut down most of its network for more than a week. Shares slumped today about $1. They finished at $21.15.
Shares of Club Corp also lower after the company said it won't convert into a REIT or real estate investment trust. Some activist investors had been calling for the conversion, but the golf course and country club operator said it's not a viable option, at least not right now. The stock tumbled almost 9% to $18.16. American Airlines reduced its forecast for a key fourth quarter metric, consolidated passenger revenue per seat mile. That means how much money it makes from each passenger on a flight. Also, the airline reported its passenger traffic edged down slightly in November from a year earlier. Shares off slightly to $50.82. The Securities and Exchange Commission is seeking to suspend Standard & Poor's from grading commercial mortgage bonds. That's according to a report from Bloomberg. The company's parent, McGraw-Hill, is still in talks over a possible settlement with the SEC, which has been investigating whether the firm changed rating criteria to win business back in 2011. Shares fell 2% to $91.80. And Verizon says its subscriber count is growing again, but it also said promotional offers and strong customer volumes this quarter will pressure its margins and earnings. Shares fell initially on that news that came out after the market closed. During the regular session, shares rose a fraction to $48.90.
And from the You'd Think We Might Learn department, easy terms for home buyers helped create the conditions that led to the housing crash last decade. But now regulators are once again tweaking the standards to boost home ownership. As Diana Olick explains, it's about creating savings and an alternative investment to stocks.
Can't afford a down payment for a home? Well, it's about to get easier with new loans from government-backed Fannie Mae and Freddie Mac requiring just 3% down.
I think there's a big problem with this because we've lived through it already.
Government is pushing home ownership again, claiming it is the best way for middle America to build wealth. But is it really?
It would be perhaps smarter if wealth accumulation is your goal to rent and put money in the stock market, which has historically shown much higher returns than the housing market.
Going back to 1987, when the S&P Case-Shiller Home Price Index was invented, stocks win by a long shot. They're more volatile, yes, but long-term, they yield owners more, not only through appreciation, but through dividends. Home prices do rise over the long term, but you have to pay into a home in the form of property taxes, insurance, maintenance, improvements. You do have to pay capital gains on stocks, but it comes out to much less. On the other hand, home ownership produces social yields.
The point is that home ownership is also a state of mind. It tends to produce people who are good citizens, who are involved in the community. They know the name of the mayor.
Shiller actually charted this back to the turn of the 20th century, and it does hold up for over 100 years. But on the other hand, you could argue that a home pays you in kind. That is, you get to live in it. So it's more of a consumption vehicle, like a car, than an investment vehicle, like a stock. What it really is, though, is a savings vehicle, because that's what you're doing when you're paying down a home loan. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up on the program, the government warns this flu season could be a bad one. And if that's the case, it could impact certain industries and businesses. One of Bernie Madoff's former employees was sentenced today to 10 years in prison. The director of back office operations at Madoff's investment firm had been convicted for helping his former boss to orchestrate the massive Ponzi scheme. 4 other Madoff employees are expected to be sentenced later this week.
It's December. That means it's flu season, and the Centers for Disease Control warns that it could be a bad one. That means more people taking sick days, and while increased worker absences and decreased productivity hurt some businesses, others benefit. Bertha Coombs has more.
It's early, but judging from the half-dozen states reporting high flu activity, the CDC is worried this flu season could be a bad one.
From what we know about the viruses we're seeing, we are concerned that it may be a severe year this year, particularly for people in the older age groups as well as for young children.
The most prevalent influenza strain this year is the H3N2, the same one that made for a severe season 2 years ago. Trouble is, vaccines are developed well in advance, and this year's formula is not well matched to that strain.
That may mean that the vaccine won't protect as well against severe outcomes such as hospitalizations or deaths. We don't know that, and so we still think that vaccination is the best first line of defense for people.
2 years ago, the severe outbreak resulted in high demand for flu shots and at times tight supply. Demand for flu treatment, Tamiflu, resulted in spot shortages of the children's formulations. The CDC says there are ample doses of flu shots this year, and the drug maker Roche says it is prepared for a potential severe outbreak this winter. With plenty of inventory, analysts say a strong flu season like 2013 could be a boon to drugstore chains such as CVS and Walgreens.
If you think about drugstores growing in the low to mid single digits, this kind of got you into kind of the mid to high single digits, and that's a pretty good trajectory change for this kind of a business and really was helpful to their profits.
For insurers, a severe flu season could be tough on the bottom line. More medications, more visits to hospitals and doctors drives up medical costs, and that could weigh on the profits of providers of low-margin Medicaid and ACA exchange plans. Bertha Coombs, Nightly Business Report, New York.
And finally tonight, call it the party economic indicator. A new survey shows that 9 out of 10 companies are planning holiday parties this year. A survey of HR professionals by Challenger, Gray, and Christmas found almost 90% of their companies will have a holiday or year-end party. That's way up from the past few years. And Challenger says this year's results are the rosiest since 2007. Employers are in the mood to celebrate, Tyler, thanks partly to a strong job market and, of course, the stock market.
Very nice. Enjoy your parties.
We had a good one here already at CNBC.
Be responsible, behave yourselves, yes.
And that is Nightly Business Report for tonight. Thanks so much for watching. I'm Susie Garrow.
I'm Tyler Matheson. Thanks from me as well. Have a great evening. Hope to see you back here tomorrow night.
Nightly Business Report has been funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
I'm Susie Garrow with a Nightly Business Report news brief. Stocks fell sharply as oil prices sank, tech tumbled, and Dow component McDonald's issued a profit warning. The world's largest restaurant chain reported a steeper than expected drop in global sales and was one of the worst performing stocks in the Dow today. Chevron and Exxon also a drag as oil prices fell to 5-year lows. The Dow lost 106 points, the Nasdaq slid 40, the S&P down 15. Merck is buying Cubist Pharmaceuticals for nearly $10 billion, giving it exposure to antibiotics that combat superbugs. The National Association for Business Economists is more optimistic about economic growth next year. And a survey of companies shows more are throwing holiday parties, thanks partly to the strong job market. Be sure to tune into Nightly Business Report right here on your public television station.